In this week's U.S. Bank Economic 360, while stock prices may be near all-time high levels, market volatility is actually heading in the opposite direction. U.S. Bank Vice President and Senior Portfolio Manager Mike Denneman joins us this morning to talk about why things are so calm and what that means for investors. He is with Business Courier publisher Jamie Smith in the studio. Mike and Jamie.
Thanks, Peg. Mike, thanks for being here.
Good morning.
So talk to us a little bit about this calm period in the market.
Sure. So, as Peg just mentioned, volatility is heading in the opposite direction of the market. By some measures, we are in the least volatile or most calm period, if you will, in more than a decade. And so this has been making headlines, of course, and what they're referring to is a statistic known as the VIX, V-I-X, which uses options, prices, and movement to estimate, if you will, the volatility in the market. So a high number means a lot of volatility.
Okay.
Prices moving very quickly, very erratically. A low number means a very calm period. And so right now, that measurement is hovering about 10. In fact, it dipped into the high single digits earlier this week. So that's an extraordinarily low number.
Yeah.
To put that in some context, a more normal average market, it would be maybe in the mid-teens to up to 20. If things start to get a little fidgety, maybe into the 30s or high as 40s. The all-time record was 90 back during the financial crisis. So by whatever metric you want to gauge, we're in a very low period right now.
What could cause this volatility to change?
Well, any number of things, of course.
Can't be easy answer, right?
No. The VIX is often referred to as the fear index, and that's because as investors become worried, the market starts to get jittery and volatility begins to increase. So, you name it, a natural disaster, a geopolitical event, a terror attack, a financial crisis of any kind. So, by, just a way of example, last year we saw VIX spike a couple of times during the election, of course, last summer around the Brexit vote. So these are the types of events that cause worry for investors. That in turn causes the volatility to increase. So what the VIX is telling us right now is that there's not a lot going on. Investors just aren't all that worried.
Yeah, it seems like I almost close our interviews every time with this question. Your crystal ball.
Right.
What should investors expect?
Sure. So, well, the VIX is very good at telling us about some things and then not so good about telling us about others. So it does indicate, of course, that it's a very calm market right now. And that kind of stands to reason. The market had this great rally following the election, but that's kind of plateaued. The market's taking a little bit of a break. We've spoken on this program many times about the summer months kind of being lazy months for the market, the sell in May and go away concept. Well, it's May, so to see the market and investors to take a little bit of a breather, that's not very surprising. So the VIX can tell us that, yes, it's calm right now, but what it can't tell us is what might happen tomorrow. As you said, it's not a crystal ball. It can't predict natural disasters. It can't predict geopolitical events. So even though we know the market is very calm right here and right now, something could happen overnight and it could go from very low volatility to very high volatility without much of a heads up.
Well, I think the one thing the crystal ball will tell us is that you'll be here to talk about it when that volatility starts to change, right?
You're exactly right.
All right. Thanks a lot, Mike.
Thanks.